I have in my hand a press release from the SEC. And while it is March Madness season, it's not that SEC. This is from the Securities and Exchange Commission, and the headline reads, Vanguard to pay more than $100 million to resolve violations related to target date retirement funds. Target date retirement funds are really popular, and for good reason. They make investing, especially in retirement accounts, very simple. All you have to do is think forward into the future and estimate when you're going to retire. And in the event that you don't know when that's going to be exactly, you can use your age as a proxy. Most people will say either age 65 or 70 or thereabouts. Target date retirement funds typically are in 5-year increments. So there'll be a 2025 fund, a 2030 fund, a 2035 fund, a 2040 fund, so on and so forth. And so whatever year, right in the title and the name of the fund, corresponds to the year that you're expecting to either turn 65 or 70 or whatever is your expected retirement age, that's the fund to select. It takes a lot of the guesswork out of it for you. Additionally, another benefit and another reason why they are so popular is because the allocations change automatically over time. So when you're very young in your career and you're just starting to invest and you're investing in a 2065 fund because you've got another 40 years to go in your career, it's going to be a very aggressive allocation. Very little bonds, little to no cash, very high in equities, more aggressive type securities. As you progress through your career and get closer and closer to retirement, the allocation is automatically changed for you without you having to buy or sell any securities or do anything with the fund whatsoever. And then finally, when you retire, you have a much more conservative approach in your portfolio than you did when you started investing, even though you may not have necessarily made any changes to your portfolio whatsoever. This is one of the reasons target date funds are so popular. And Vanguard has one of, if not the largest suite of target date funds in the country. Now, moving on back to this press release, the first paragraph goes, the Securities and Exchange Commission announced that the Vanguard Group will pay $106.41 million to settle charges for misleading statements related to capital gains distributions and tax consequences for retail investors who held the Vanguard Investor Target Retirement Funds in taxable accounts. Now, there's a couple of really important things right there in that sentence. One, this only impacts investors who are invested in the investor class shares. Vanguard has investor class shares and institutional class shares of many, if not most, of their funds. And the primary differences are not with the management or with the holdings of the portfolios, but primarily with the minimum investment required to invest in that particular fund, and then consequently the fees. So for institutional versus investor class shares, you might have a couple $1 million in the institutional side of minimum investment necessary to invest in that fund, and you'll have a much lower corresponding fee. Whereas in the investor class shares, you might have a minimum investment of only a couple of $1,000, but the fees will be relatively much higher. It makes sense. The more you invest, it's only one relationship that they have to manage, and therefore they can pass the savings on to you. So this all started back in December of 2020 when Vanguard announced that the minimum initial investment amount of the Vanguard institutional class target date funds was going to be lowered from $100 million to $5 million. That's 1/20th of the minimum initial investment. That's a major cut, okay? So there's a lot of people and a lot of companies that, didn't have $100 million to invest in this suite of funds or one particular fund, right? But they did have $5 million. So between 5 million and 100 million, there's a lot of potential, investors there. And what happened is a lot of individuals and a lot of companies, because these are really popular in 401k plans, decided to move from the more expensive investor class shares into the less expensive institutional class shares, because now they met the new minimum requirement of $5 million. But they never would have met the $100 million minimum requirement that was set forth before. So minimum requirement comes down, and a lot of people say, hey, Why not? I'm definitely going to change from investor class shares to institutional shares because all of a sudden it cuts my fee significantly. Who wouldn't do that? You're getting the same product, the same service, the same everything, but you're paying a whole lot less for it. It just makes sense. So what had happened is in the following months, not surprisingly, as we talked about, substantial number of retirement plan investors redeemed their investor target retirement funds and switched to the institutional target retirement funds because they had lower expenses. And so, in order to meet the demand for these redemptions, the investor class total retirement funds had to sell underlying assets with gains due to rising financial markets that had rebounded from pandemic lows. Keep in mind, this is December of 2020 when this all starts. So we're about 9 months, post the start of COVID. So typically, most investors are in retirement or qualified accounts when they're invested in these target retirement funds. So they have basically a big cushion or a moat around their investments from a tax perspective, right? You can buy and sell within an IRA to your heart's content, and you don't have to pay taxes on capital gains or dividends or anything until, of course, once you're retired and you start pulling that money out. That makes sense to a lot of people. And what they may be forgetting in some cases is if you're invested in a vehicle like a target retirement fund, but you're not invested in a qualified account or an IRA or 401k, right, that has special tax privileges, you actually will have to pay capital gains and dividends taxes on an annual basis. And there's a couple of different ways that taxes will hit you from a capital gains perspective. One is you buy security for $1, sell it for $2, you've made $1 capital gains, right? But the fund itself can actually sell securities off at a gain, and some of that will be passed on to the investor if you're in a taxable type account. So think like a regular individual account or a joint account with a spouse or something like that, right? So that's what you're looking at here. This was a situation where you had everybody moving out of investor class shares into institutional class shares because of the lower costs. And now these investor class shares had to sell a whole bunch of securities because they didn't have the assets anymore, right? They had to make up for the redemptions, which were then again purchased right over here. But they had to sell those things at a gain, and those gains were passed on to the investors, at least the investors that are not in tax qualified accounts, IRAs, 401ks. So basically, that's the gist of what happened. What the order finds is that the Vanguard investor class target retirement funds prospectuses that were distributed in 2020 and the subsequent year 2021 were materially misleading because they stated that the fund's distributions may be taxable as ordinary income or capital gains, and that capital gains distributions could vary considerably from year to year as a result of the fund's quote unquote normal investment activities and cash flows. However, the order finds the prospectus failed to disclose the potential for increased capital gains distributions resulting from the redemptions of fund shares by newly eligible investors switching from investor to institutional class shares. So basically, Vanguard didn't do enough to disclose that this is a situation that may come up that's atypical, not normal as per their prospectus. And what was written in the prospectus was not sufficient to warn individuals that this is something that might happen. Now, there's a couple of takeaways here that I think are very important. First and foremost, these funds were designed to be held primarily in retirement type accounts. I'm not saying that they're necessarily tax inefficient. I'm sure that varies from fund to fund and company to company. And Vanguard's not the only company that has funds like this. But it's also, there's another point, and I got to remember to mention it. It's kind of the no good deed goes unpunished thing here. They're actually cutting minimums and allowing more people to invest in lower class or lower cost shares in a different share class. And because that has some negative impact on the folks that remain in the investor class shares, they're being punished to the tune of $106.41 million. Now, they're probably taking a hit in terms of profitability because you had all of these people over here paying X for professional management of these funds, and now they're paying X minus whatever the discount is, right? So that's kind of the first thing. It's kind of a kick in the nuts, if you will, to a company trying to, in my estimation, do the right thing at least. And I understand that they either maybe didn't disclose fully or didn't expect, and maybe they should have expected and they didn't, the mass exodus of folks that were now eligible for institutional class shares coming out of investor class shares that would trigger all of these capital gains. Now, if that's the case, then it's a failure of management and a failure of disclosure. And yes, you got to pay whatever fee the SEC says you've got to pay. My understanding is, at least according to this press release, the $106.41 million payment is going to go towards the affected clients. Now, the questions I have that were not addressed in this particular press release are the following. Does this make these clients whole? Does it cover the amount that they had to pay in capital gains taxes or excess capital gains taxes over and above what's considered normal per the prospectus? Two, is the amount different from client to client? For example, if you have twice as much money invested in the fund as I do, and therefore twice as many capital gains, do you get a check for twice that dollar amount than me, or is it a flat $100 for everybody that's invested or that's on the client list for that? These are all questions that I have that I'm sure there's answers to somewhere. There is a quote unquote fair fund that was mentioned in this particular press release. I'll link the press release in the description down below if you guys want to check it out. It's an interesting read. It's only about 2 or 3 pages long, so it shouldn't take a long time. But there's a lot of questions that it leaves unanswered. Also, I'd be curious to know, in the event that the prospectus says something to the effect of, well, if this is in a non-taxable account, you might get hit with, substantial capital gains. Would that have been enough to void this action by the SEC? Or would that decrease the amount of the penalty that Vanguard would have to pay? And also, what effect is this going to have going forward on mutual fund companies that are attempting to lower minimum investment amounts on particular share classes? Does it have a chilling effect on that? In which case you have a whole bunch of investors paying more for, the same fund management effectively, because the company refuses to lower the minimum for fear of having a exodus from the more expensive share class into the less expensive share class, and therefore triggering capital gains. Is this a net positive for investors? There's a lot of issues that kind of are up in the air regarding this. One thing I would want to know, if I were the Vanguard Group or any mutual fund company for that matter, is what kind of language could I have used in the prospectus that would have, fully absolved me of any guilt in this situation? And the answer probably is, it depends on how good your lawyer is, right? And what the definition of quote unquote normal activities are. Because this may be considered normal by some and may not be considered normal by others, as evidenced by this particular press release. So it's really an interesting situation. Is it a no good deed goes unpunished scenario, or is it a company trying to do the right thing but just failing to have the proper disclosures? Because I don't know about you, but most of the clients I work with, they'll take a glance at the prospectus, and of course the prospectuses are always provided to them. But few people read it cover to cover, and I imagine the majority of folks that do read it cover to cover probably don't understand everything and probably can't think through and predict everything that might potentially come as a result of a particular corporate action, such as lowering the minimum investment on one share class and the resulting capital gains. Another thing to keep in mind as an investor is, if you're investing in target date funds, or any funds for that matter, there is the potential for capital gains, sometimes significant capital gains. A lot of it depends on the market. A lot of it depends on how you're trading within the account. But the fact is that even if you're not doing any trading, the funds could kick off capital gains that you'd be responsible for. So it's important to have tax-efficient investments in those types of vehicles, and maybe keep the target date funds and things specifically for retirement in retirement type vehicles that have tax advantages that don't require you to pay taxes on a year-to-year basis, allowing you to have those gains continue to compound on your behalf. I think that's about it for this particular story. If you have questions, comments, concerns, leave them down below. Otherwise, I'll talk to you guys next time.